Welcome to tutorial on shortlisting process. Today we will learn debt equity ratio, current ratio and market capitalization. These terms are connected with safety of our investment. Let's understand the concept of equity. Assume somebody built a house. Current market price of the house is 75 lakh rupees. This is an asset to that person. In order to complete the construction of the house, he availed a loan of 35 lakh rupees. This is his liability. So remaining 40 lakh rupees is paid from his pocket. This 40 lakh rupees is said to be his equity or net worth. In other words, difference between asset and liability is called equity. Debt to equity ratio. As the term indicates, it is the ratio between debt to equity. In this case, debt to equity ratio can be calculated as 35 lakhs divided by 40 lakhs, which is 0.875. We can apply this example to a company. Company has machines, equipments, buildings, land, investments, etc. as their assets. At the same time, it has liability as well in the form of debt, unpaid taxes, money owed to suppliers, etc. Net worth or equity of the company is the difference between asset and liability. If liability increases, equity decreases, which is not good for a company. Debt to equity ratio gives us an idea about to what extent the company is financing its operations with loans. Lower the ratio, better is the financial condition of the company. Debt to equity ratio less than or equal to 0.5 is considered safe. Now we should understand two important terms, current assets and current liabilities. Some of the assets of a company are expected to get sold or consumed within a period of 1 year. Examples are cash, pending payments from customers, which is called accounts receivable, then stock inventory, short-term investments. All these are current assets. Current assets are used to fund day-to-day business operations. Similarly, some of the liabilities of the company are expected to be settled within a period of 1 year. Examples are short-term debt, pending payments for suppliers, also called account payable, then dividends or profit share given to shareholders, then taxes. All these are current liabilities. Current liabilities are usually settled using current assets. If current liabilities are higher, then the company will not be able to settle them with current assets and the company will be in trouble. Here we should understand one factor called current ratio. Current ratio is the ratio of current asset to current liabilities. Higher the current ratio, safer is the company. A current ratio greater than or equal to 1.5 is considered safe. Now we will learn market capitalization. Assume the company has 1 crore shares and current market price of each share is 100 rupees. If we multiply number of shares and its market price, we get 100 crore rupees as result. This is the amount I have to pay if I decide to buy the whole company. This amount is called market capitalization. Market capitalization indicates size of a company. If a company's market capitalization is very low, that means the company is a very small cap company and it will be greatly affected by any slowdown in the economy. So the risk involved in such companies are more. For our investment purpose, companies with market capitalization of 25 crore and above can be considered. So in this video we learned 3 conditions that are important for safety of our investments. That is debt to equity ratio, which should be 0.5 or below. Current ratio should be 1.5 or above, and market capitalization should be 25 crore or above. Don't forget to subscribe the channel by clicking the bell icon.